Welcome to Two Quants and a Financial Planner, where we bridge the worlds of investing and financial planning to help investors achieve their long-term goals. Join Matt Ziegler, Jack Forehand, and me, Justin Carbonneau, as we cover a wide range of investing and planning topics that impact all of us and discuss how we can apply them in the real world to achieve the best outcomes in our financial lives.
Jack Forehand is a principal at Validia Capital Management. Matt Ziegler is managing director at Sunpoint Investments. The opinions expressed in this podcast do not necessarily reflect the opinions of Validia Capital or Sunpoint Investments. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Validia Capital or Sunpoint Investments.
So Matt, for the last 3 or 4 years, I've been writing an annual article about value investing and whether it's dead. And the reason I do it is because I've always been a big believer in value investing. And I think you have to challenge that. And the way I found it was best for me to challenge it was to try to write out my best case against value every year, and then to come back and reevaluate it. And the one thing that's happened this year is that I've become much more lazy. So now I'm not writing anymore. So now I'm like, you know what? I'm just going to get on with Matt, and we're going to do it this way. So I don't have to actually write an article. So that's what puts us here where we are today.
Well, good. I'm glad I'm at least one step better than a GPT prompt for the sake of getting this out of you today. So Jack, is value investing dead? Is this where we're going today? We're going right.
I'm actually thinking, just as you said that though, like in my path to lazy, maybe next year is the GPT prompt. Maybe we don't even record the podcast with Matt. Now it's basically just like Chat GPT, is value investing dead? And then just call it a day.
I accept my role as a rebound between laziness and despair. I accept that.
So anyway, yeah, to your question, like, I think the most important thing to ask here, and we're going to go through all kinds of arguments against value investing, but I think a good place to always start is, what is value investing? Because everybody defines value investing in a different way. For those of us that are quant investors, value investing is buying all these statistically cheap companies. And you can do it. It doesn't mean the price to book. I mean, you can do it in a lot of different ways, but it's basically buying statistically cheap companies. But a lot of other people will look at value in a different way. And I always like to look at this, to use this example of Graham versus Buffett versus Bill Miller. Like, buying the really cheap cigar butt type companies is sort of Graham value investing. Then you've got the evolution of Buffett over time. Let's buy high quality companies at a discounted price. And then you've got the Bill Miller approach, which is the one that's worked a lot better, by the way, recently, which is, let's look at the future cash flows this business can generate, and let's discount that back to the present, so I can buy companies that are losing money now and have them be value companies because there's so much potential in the future. And by the way, that has been the best approach so far, like in the past decade of the three. But I think it's just important to say, like, value investing really can't be dead if you look at value investing as buying something for less than it ends up being worth.
Just curiously, which one of I'm saying the three between Graham, Buffett, and Bill Miller, like, which one of those do you default identify with the strongest, just your personality?
I mean, I probably, in personality wise, it's probably Graham. So that's something I've had to fight over time, because I tend to want to go too far that way. So when I build quant models, I tend to be more balanced in it, just because I have to be careful of fighting myself that I really want to buy the statistically cheap stuff. And I think there's a better way to do it as you kind of diversify and add quality and do other things.
Yeah, I think it's interesting because I think, so number one, it's important to acknowledge that all these things are out there. But then second to that is, it's good to know the default way you approach this stuff, because I think like my default is in the Buffett camp, whereas I respect the math of Graham and I respect the people who can program all that stuff, but I know there's a certain inertia or laziness that keeps me from going through all that. And then the same way, like the Bill Miller idea of being like, well, Bitcoin makes sense or something. And I'm like, oh yeah. But then I get Bill Miller's dangerous because I'll get swept up in the story and I can't back it up the way that he can back it up. And I'm very comfortable in my Buffett lane. I also realized we had a lot of family over the house, so we're a Buffett-ish household. I realized as I was moving to get my chair, I have this like giant thing of white distilled vinegar because it was on sale. And this is what my wife's got because, it's a good deal and it's not a cigar butt. It'll get put to good use. But
Are you a Costco guy?
I was, but then we moved to an area where there's not a Costco, and I've kept myself away from Sam's Club or BJ's or whatever's up the road from us. But yes. So my mode is not to like clip all the coupons and go full Graham. And it's also not like to go, I don't know what the Bill Miller discount shopper orientation would be, but in my household, we know a good deal when we see one, and the Buffett identity is strong.
Yeah, and I run into this Costco thing. It's part of my value thing is I'm like, these 8 blocks of cheese are an incredible deal. And then you're like throwing out 4 of the blocks of cheese. You're like, maybe this wasn't the value I thought it was.
Well, so my point in this is I think it's important before anybody debates this stuff or even thinks about it, we all have default views that we approach this stuff from. We all have the way that we're wired. And a big part of this exercise, or even having conversations or writing articles, the way you've written articles about this, is going, here's how I naturally see the world or process information. And now we're trying to like stretch those boundaries a little bit, which is part of why I think it's so interesting. Go back to the Mobison point again, the just buying something for less than it's worth. How do you?
Yeah, this is, you and I are going to get to an interview Aswath Damadaran tomorrow. And this is something they both kind of agree with, which is, value is ultimately, if you buy something and then it ends up being worth more money, it was a value. And so they both play in this world of statistically cheap companies is not what value is. Value is figuring out what something's worth and paying less than that. And so you can be a Bill Miller style of value investor if you can take Airbnb, when it comes public, and you can figure out what the potential future cash flows of that are, and you can buy it for less than that. Like Google is a great example. I mean, Google looked very, very expensive when it came public, but it was exceptionally cheap relative to what it did. And that's an example. Like that was value investing. As much as people like me can shake our fists with our price to book ratio all day, like that was value investing. If you were someone who could have figured that out, you made a lot of money.
So this is where something feels wrong about the backwards logic applied forward of this. It's not just anything, right? It can't just be like anytime I bought something and it's worth more. I had to have some logic up front. I had to have some scientific-y sounding word that basically said like, this is a value play. I think this is cheap relative to the future. Is that a precursor here? Like you have to use something to look forward on this and why you think it's cheap. You just can't in hindsight be like, oh, a genius value investor.
Yeah, no. And Damadaran's a great example. I mean, if you've seen one of his valuations that he does, like they're extensive. He knows the space. He knows what's going on. He's one of the world's biggest experts in valuation. Like he's able to look at these companies in advance and figure out, yeah, there is value here. Now, most people can't do that. I mean, I could have given you the projected future cash flows of pets.com and it didn't work out that way. Those cash flows never came. So for every Amazon and Google, there's a lot of other companies that just doesn't work out. So it's a hard thing to do, but it is right to say that if I'm able to do it, if I can figure it out, like those types of companies are values. If you can figure out that they have this massive potential and, if you can bring that back to the present and you can see, wow, that price doesn't really reflect what this company could ultimately do.
If I had a time machine, I would totally go back in time and go into not cooking the books, but I want to invent ratios for those companies. Like price to bark ratio. Like I want to pick some companies that go under and like give them the community adjusted EBITDA numbers for these things to say why they're cheap.
Yeah. And I think the other thing here is like, this is anytime there's people as smart as there was the people we're talking about on both sides of an argument like this, you have to understand this is a tough thing to figure out. First of all, we can say value investing can't be dead because you can measure it in different ways. But even if we're talking about just go back to statistically cheap value investing, like there's some really, you would have the Cliff Asenesses of the world saying, no, it's not, it still works. You would have the Aswaths of the world saying, no, it's not going to work anymore. Those are both really, really smart people and smarter than me. And so the idea here is not for me and Matt Ziegler to figure out whether value investing is dead. The idea here is to tackle all the different things we can think about to say, how can we decide for ourselves what we believe about whether value investing might or might not be dead?
Yeah. And do that with the evolving landscape of the marketplace for these things. Because I think what's amazing, going back to that original point about Graham, then Buffett, then Bill Miller, and carry that forward to wherever you want today. I think you could probably even do a more modern version of that in, Andreessen Horowitz or something probably too, is you get this happening. Like it occurs from both sides. So it's not just the investors, the people like us, or the people who are going out and trying to buy new dollars into these things and saying, I'm going to exploit these opportunities I see taking place in the marketplace. It's other people on the flip side of it coming up with stuff like community adjusted EBITDA, coming up with stuff that's going to basically say like, look, we're cheap on these new metrics or these made up metrics or in this new way of categorizing thinking. The world keeps getting more complicated as more data comes out, as more stuff comes out, and the things that maybe worked back in the day for Buffett or Graham or in prior years they definitionally can't apply to now because the whole marketplace is treating those stories in new and different ways.
What you said is so important because when you have things changing in the world, and we'll get into this later, sometimes new metrics make sense. Sometimes, the price to book ratio doesn't make sense anymore. I need a new metric there. But sometimes also the new metrics, community adjusted EBITDA, are a bunch of garbage that they come up with. And so it's very hard to balance that. Like, it's true that there are new metrics that have to be used to value companies, but then the companies are going to take it as far as they possibly can to price to whatever ridiculousness they can come up with to try to make themselves look cheap. So that's the hard thing as an investor, is you have to say, yeah, things do change, but I also have to realize companies are going to take this to an extreme to come up with something that probably is not tied to the fundamentals of the company in any way.
I think it's always fascinating how this ties back into remembering there's two sides of a market. You can't have, like, is value dead doesn't mean is growth alive. Is value dead just basically means, like, how is value being used in the stories that are told that both, like, drive flow and ultimately drive the investing decisions of people who are allocating capital on both sides of the equation. Are they selling stuff because they think it's richly valued? And that applies as much to saying, I'm going to sell some of these large cap, US growth stocks because the valuations are rich, as it does the large cap growth stock saying, we're going to sell some shares of stock to the market to raise funds for the next venture to help fund this growth. It all applies. It just keeps changing as the whole marketplace changes over time, buyers and sellers together.
So let's take a step back before we get into this and talk about why we're having this discussion. The reason we're having this discussion is over the long term, the cheapest decile of companies. So if you use price to book was typically used in the research, but you can use anything. Price to cash flow, whatever, EV to EBITDA, you can use whatever you want. But the cheapest decile has typically outperformed the market over time. The most expensive decile has typically underperformed. And you've had, it's moved in a pretty decent line in the middle. And so if over the 100 years, if you've bought statistically cheap companies, it's been a good investment strategy. It's had its periods of struggle, but it's worked out. In the past 20 years, that has not been the case. We're looking at, like, literally decades now where that type of approach has not worked. And the growthy type companies have actually outperformed and the value type companies have underperformed. So that puts us in a situation where we need to evaluate now what's going on. And this is the absolute hardest thing to do as a factor investor, is when you see something that's worked over really, really long periods of time and it stops working for a period of time, trying to judge, what do I do with this? Is something broken, or is this just one of those underperforming periods you always see? And this is, like, there's no answer to this, but this is absolutely the most, and you can't do it statistically, by the way, because this is something Corey Hofstein talked about in Factor Fimbulwinter. Like, if I wanted to do this statistically, the amount of data I would need to say value investing is dead is longer than my investing lifetime. So I can't do that. So I, as a person, have to look at this, and I need to look at these arguments we're about to go through, and I have to say, do I believe these arguments that statistically cheap companies are not going to outperform anymore? And it's a really, really tough thing to do.
Really, really tough to do on average, right?
Right.
You can get lucky once. You can have the thing hit. You can have the thing miss, but it's really hard to do reliably on average that you're going to be more right than wrong. It's also really interesting, I think, inside of these things to consider how the information got introduced to the world, the marketplace, to the access to information. And we're going to talk about this a bit more, but it's like the information gets out there. It kind of feels cruel, right? You and I are both of an age where enough of this was available. It had worked well enough statistically up to the point in time that by the time we could learn about this stuff, it was due to have a 20-year failure period.
Yeah, that's right. And it's, and then that's an important point, because if you look back at, like, Fama and French's work, typically when any of this stuff becomes public, it doesn't work as well. That's just part of the deal. And that's true with Fama and French's work. Like, we had Andrew Chen and Alejandro Lopez Lira on excess returns, and we talked about this. Like, post-publication, the factors haven't worked as well. And by the way, they did all this stuff where they data mined a bunch of factors which were not available publicly, and the same thing happened. It also, post-publication, it didn't work as well. So that's just part of the deal, is, like, when this stuff becomes widely used, when it becomes, it's disseminated into the public, it's not going to be as good. But the question is, does it still work? So maybe value investing doesn't work as well as it did before it was widely known by everybody, but maybe it still works. And that's the challenge here. And that's what we're trying to think, as we get into these explanations, we're trying to understand, like, what are the pros and cons of that idea? So, so before we start, I think one thing I did want to do is, I wanted to look at why value investing works, because I think it's important to keep that in context as we go through these things. So typically academic research will have two reasons value investing works: a risk-based explanation and a behavioral explanation. So the risk-based one is very simple. Value stocks, stocks that are cheap statistically are riskier than the market. Therefore, you would get an excess return for investing in those types of stocks. The behavioral one is basically there's a mispricing going on. So people overestimate the problems. Obviously, if a company's cheap, there's problems. Something's going on. Something's gone wrong with the company. Across a wide group of those companies, people overestimate that. And therefore, if I buy a basket of those companies, I can benefit from the fact that eventually they're going to realize things aren't as bad as they seem. So those are the two explanations that you'll get in academic research about why value investing works. And I just think it's important to keep those in the back of your mind as we go through these reasons why maybe it doesn't now.
Both reasons, both sides, again, think in terms of variance and think in both directions. Because whether it's the risk-based idea of stuff goes bad or stuff goes really well, or behaviorally stuff goes bad and people are reacting it to it going bad, or stuff goes really well and people are overreacting to it going really well, they both have that buy and sell side. And I think it's really important to think about it in those terms from both the buyer side and the seller side, and how they might be contemplating what the story is around the valuation at that point, using this type of methodology to understand just the types of stories that you have to tell to justify the future that you want to see. That becomes really, really important as we think about how this has evolved over time, how it exists right now, and then how we apply it in our own practices, either as allocators or individual investors, to make sense of, because this is all we're doing, is just trying to make sense of the prices on the page in front of us and go, can I fit this with something that makes some logical sense to me?
So let's get into number one here. And this is my role as a value investor is to rail against the Fed. So now I'm going to rail against the Fed for an extended period of time. No, I'm not actually going to do that, but that is the number one reason here. And one of the things people have suggested is that the Fed changed the game when they kept interest rates artificially low for a very long period of time. And, if you're a believer in the theory behind it, you could say in a period of low interest rates, growth companies have way more of their value in the future. You discount those back at a lower interest rate. Growth is worth more than value. Therefore, by keeping rate down for an extended period of time, the Federal Reserve killed value. So that was my initial thing. And then I kind of took it back and I said, well, now rates are higher. So this is not going to be the case anymore. Now this is better for value. But I've since gone to like the third thing, which is basically, I don't think this really matters all that much. I think when you look at the long-term data to suggest the theory is really, really strong in terms of interest rates and the performance of value against growth, I think the data doesn't show anything almost. So I don't think the data shows that during periods of high rates, value outperforms or that it underperforms during periods of low rates. So I think to a large extent, what the Fed is doing is probably irrelevant. And I think some of these other reasons probably play a bigger role on whether value is dead or not.
The Fed is one of those things that personal belief, personal opinion is, it fades in and out of where people really care and when people don't really care. And I think in the pervasive ADHD of the last, 5 years, but certainly the last 20 years, as it's probably like grown more and more and more, the amount of attention people pay to stuff with the Fed, and if it's going to show up in places like factor regressions for value, and if it's going to work, the amount of time we spend in the moment when there's a big Fed decision or a big comment like we got at Jackson Hole the other week or something else, where everybody's laser focused on it for a second, but they're not laser focused on it for like a 3 or a 5 or a 10-year period, while we're waiting to see if something like the value factor has produced some type of, excess return or whatever else it is in time. I think of it a lot like it's blaming the Fed or just pinning something on the Fed that's not a very momentary point in time complaint, acknowledgement, whatever. It's a lot like saying, like, the 10 Commandments were written and then everything was fine. It's like, no, there was still a lot of chaos going on around it. Even when Moses comes down, when Charlton Heston comes down off the mountain in the movie, like there's pandemonium taking place. Like these things, these institutions, they punctuate time and that they put the highlighter on different things. But then, I mean, how many times does the value factor work over like a 3-week period around a Fed announcement? It's just noise.
Yeah, no, absolutely. And the other thing, and first of all, I don't think anybody's ever brought Moses into a Investing Dead podcast, but Matt Ziegler could do it.
There's not enough Charlton Heston on this podcast, damn it.
But the other thing is, like, I hate all this. And, I used to do this early in my career, but I hate all this blaming whatever for whatever's going on in the market. Like, we don't even know what's going on. But second of all, like, if the Fed had kept rates low forever and that was part of the thing, I mean, you've got to play the field that's in front of you in investing. Like, as an investor, you can't be like for 2 decades being like, well, I've underperformed because the Fed is screwed up the market. Like if the Fed's going to keep screwing up the market, then figure out something that works when the Fed screwed up the market. We know short-term performance is noise anyway, but I hate the idea of like trying to say, oh, we underperformed this year because the Fed screwed us or something like that. I just don't think there's any validity to that.
Yeah, this is where you have to take less like there aren't like formal mathematical rules to this stuff. And this isn't to say go out, lie, cheat, and steal your way to profits, but it is a way to basically say like, I don't know, you're playing sports with your kid brothers or something when you're a little kid. And like, if your brother's cheating a little, like you have two options. You can go tell mom and dad and complain about him cheating, or you can figure out how to out cheat the brother. And this is one of those things. Did the Fed change the game? If you really think that, and you know that the game has been changed, then you should be able to theoretically profit off of those changes. The people who make that complaint but don't do something to like structurally have an advantage, if you're so confident in some new set of rules, shouldn't that be an advantage to you? That's what always bothers me when people say
yeah,
that.
but before we move on to the next one too, I will say like I've come around to Meb Faber on this one. Like this was one of his, we did this podcast with him of like the things he believes that 75% of investors would disagree with. And his first one was that the Fed has actually done a pretty good job. And I think I agree with him for the most part. I mean, I think they have a really, really tough job. And for the most part, I mean, they obviously relate with inflation and they make mistakes, but like you won't see me railing too much against the Fed because they have a tough job. And I think they've done a halfway decent job of it.
It's one of those, could they have done worse? I think that's one of the measurements that I have.
Certainly they could have done worse.
When I think about the Fed. I look at a lot of things and I'm like, was it great? No. Did it feel good in the moment? Not always. But in so many cases, could I imagine a far, far worse scenario to this? Yes, I could. I kind of think about this as, and we're talking about a value as investing is dead, but I keep in my brain, whenever we have this conversation, and it might have even been one of your, might have been an excess returns cover. All I can think of is the Monty Python, bring out your dead thing. Like that's just what's in my mind whenever it is bring out your dead. Oh, not quite dead yet. Like, yes, you are. Shut up. Like bureaucracy, whatever. Like that's how this feels. What are we really complaining about here? I could see ways this could go a lot worse. And not that I'm willing to give everybody just a total pass on this, but I think I'm with you and Mab more and more on this point.
So my second one is that too many people are doing it. So too many people have become value investors. It got discovered. Everybody became value investors. And so it's not working. And I'm not a huge believer in this, but I think there is some truth to it because you have to say when Fama and French's work got published, the premiums deteriorated after that. So you do have to say the fact that it became public, the fact that people knew about it led to lower premiums than were there in the past. But the reason I'm not a huge believer in this, it comes down to value spreads. So I can look at the spread between how expensive growth companies are and how expensive value companies are. And I can look at whether that's compressing or getting wider over time. Now, what would I expect if everybody becomes value investors and they all start buying the statistically cheap companies? I would expect compression. I would expect those spreads to be tight. So if this was true, that's what I expect to see, but that's not what I'm seeing. I'm not seeing like 99th percentile wide spreads anymore, but I'm still seeing pretty wide spreads relative to history. And so that to me says there's not just this flock of people, going to become value investors. And if anything, if you think about how people behave, like after what we've witnessed in the past 20 years, like you see people at the cocktail party racing out to be value investors. I mean, it doesn't seem to me like people are all pumped up about it right now.
When I go on the Reddit and I read the message boards about the GameStops and the coins, they're all value investors there, Jack. All of them, every last one. I have a question about this on the spreads point too. I think this is an interesting point. When you're talking about the spreads, you're also talking about, it's not like we're talking about like microcap stocks or places where liquidity and spread are very, very closely tied. When we look at like spreads and deciles, we're typically talking about larger capitalization stocks with some amount of volume going through them. So
Yes.
We're saying places where people regularly transact, those spreads aren't crazy. It's not to say there's not like little private company spreads that are still bananas, but it's like anywhere you see actual volume, those spreads are not as wild as you would have imagined.
That's right. If you look at it in just the large cap space, that's true. The way we do it is we filter out illiquid names. So we have small, mid, and large cap in there when we look at it. But this type of stuff you're talking about, like the $5 million market cap company, none of that's in there. Like I think it's for us, like 200 million or more of market cap. You have to have a certain amount of volume. Like we use our investable universe of companies we think we could actually buy if we wanted to buy them. That's what we use when we look at stuff like that. But people have looked at it in the large cap space and it still holds true. So I don't think you're seeing tight spreads anywhere right now for value versus growth.
Which is really interesting because, to your point, if too many people were doing it, then it's not like they're all going to become treasury bills overnight, but those spreads would be much tighter than they are.
That's right. So our third one here, and this gets back to our friend Ben Hunt, is the idea that narrative is driving the market now more than fundamentals. And this is interesting. I mean, this is, by the way, is 100% true. I think, at least. Like from what I see, I think, narrative it plays a much bigger role in the market. And then the question is, if narrative get things separated from fundamentals for individual companies, how long can that last? Can that perpetually go on forever? Like, how do those two things relate together? So you may have better insights than me on this, but I think it's at least something interesting to consider right now, that we are in more of a narrative driven market than a fundamentally driven market.
I think Ben would agree with this point too. When I say it this way, it's the combination of narrative and the combination of flow behind it. And I'm very much enjoying, and I don't know if he originated it, so he gets at least partial credit, if not full credit for this. Our friend Dave Nodig has been referring to this as FREEM. Have you seen the FREEM acronym floating around?
That's
yeah,
great.
flow rules everything around me. Get the money. So this concept of not just do you have the story, but then you also have flows. And I think those actually are interwoven on this idea, because back to the idea, you have to talk about the buyer, you have to talk about the seller, you have to talk about how they make the market together. Each of them is telling a story. The seller needs a buyer, the buyer needs a seller with a story that gets them to transact. A core function behind that is the idea of flow and how that permeates this market. Because if those flows tip in a more aggressive manner in either direction, that's where we get these imbalances. This is where we get these dislocations. This is where we get crazy stuff, whether it's a financial crisis or Volmageddon or whatever else. So being able to track both what are the dominant narratives of buyers and sellers, and what component is flow and therefore volume playing in those stories at any point in time. And if you're not looking through to that level of understanding, you're probably missing something that's bigger than the statistical artifice of whatever it is of saying like, oh, stocks are at 21 times forward earnings again.
And you have now worked Moses and Wu-Tang into the same episode, I believe.
Yeah, we got Moses and Wu-Tang in here. So watch
Again,
out.
something that's probably never been done before, I would guess.
Method Man.
But anyway, moving on. This is another one from, I've been doing tons of preparation for our Oswath interview coming up. And this is one he believes, which is that if you go back in the day, like back in Ben Graham's day, like if I wanted to find these cheap price to book companies, like what would I have to do? Like I'd have to go to a physical location. I'd have to get out this stuff, like these annual reports. I'd have to pull the stuff out of there. I'd have to do the calculations. Like it was hard to figure out like what the cheapest, companies passing like a Ben Graham price to book screen were. Like it wasn't easy. Now today, if I could do it right now, like while you and I are talking, I could go pull up a list of them. So his point was, when it becomes that easy, do you expect it to still keep working? And I think it's a valid point. Now, the other side of that you would take is most value investors are doing things more sophisticated than that now. They're not just doing, at least people who are doing it well aren't just saying, well, I'm just going to buy these cheap, price to book companies and I'm going to call it a day. That may work, that may not work, but most people aren't doing that. But I think Aswath is 100% right about this. I think you shouldn't expect, like when something was very, very difficult to do in the past and you got an edge by doing it, and now it becomes so easy that anybody can just do it, you shouldn't expect to get the same returns from that in the future.
Back to think about this from both sides. Not only are the tools available, but they're available to everyone. And if you're in any position of trying to shape a story, you're going to use those tools in a way that's advantageous to your story. Not necessarily to defraud people, although in some cases it's certainly used to defraud people. Back to the narrative and flow piece of it. But when you come up with like a WeWork, just as an example, WeWork knows, because of the quick availability of tools, it's not just somebody who had to go down into the accounting basements of the accounting basements of the WeWork building to pull out the physical files of the thing to go like, well, our price to book value is pretty ugly. It doesn't just stop there. It's like, well, we know because QuickBooks can tell you some of these calculations. You can go in, any small business has access to stuff like this. It's so easy to have a balance sheet these days. We know the balance sheet for basically like all of our clients. Like this is not something that's complicated or takes a whole lot of pen, paper, and calculator time to come up with. And therefore, if you're on the opposite side of this, if you're a company who's growing assets, like you're a WeWork and you're like, well, here's all the ways we value a real estate company. Man, we look like crap on all these metrics. We better invent some new metrics and some new stories to go around them to try to persuade investors that there's other ways to think of us. What if we thought of ourselves as a tech company instead of a real estate company? And I'm picking on WeWork, but this is the idea. Those tools aren't just there for buyers, for us to be more nuanced. They're there for sellers and people on the other side of the table too, to go, okay, we know these don't work, so what else do we have to do? And it just muddies the water.
Yeah, you will see that with companies. They'll basically tell you, like when they report, they'll be like, this is the ratio you should be paying attention to. And it typically won't be those standard ratios. And the only other thing I'll say on price to book is, it is possible price to book still works over the long term. Like I'm not saying it doesn't. To me, if you go back to the risk base and the behavioral explanation, it's possible, both of those might still hold. Those price to book stocks are still looking pretty risky to me. They're all over the place. It's still very possible people are fundamentally mispricing those stocks. Now that's where you'll get the pushback from people like Oswald more, I think, is, are they really doing that or not? I think it's possible that'll work over the long term, but I also think if you're going to do something like that, that's really, really simple, you definitely have to be in for a wild ride and you have to lengthen your time frames. I don't think that stuff's going to consistently work. I think you're going to pay a price in terms of really long periods of underperformance. And I do think there's better ways to do value than these really, really simple, let's just buy cheap price to book stocks.
You got to ask that question, like who's selling it to me and why? And man, could there be any other, like the easiest person to just dump something on is somebody who's dogmatic in their principle and believes in any one thing. So like, so long as there's a tribe of, value thumping gramites, like running around, like there's an always willing buyer of some crappy little security that you're like, well, it's cheap on a price to book basis. I know who will buy it. Hey, Jack, where's my bid?
It could be me. That's possible.
It's dark, but again, you got to think about it in both directions.
So this next one's interesting. This is something I put in my original article. And this is this idea of big data. And so the idea is, do people have information? If you're thinking of like value investors as people who are just using what's on the fundamental stuff that gets reported, are there people that have other information that know more? And so my example is like, you probably at any given time have several drones up over various Walmart parking lots, where you're trying to figure out like if there's cars there and if Walmart is truly an attractive value. So with your drones, you might have an advantage over me. I'm just using the financial statements. I don't realize Walmart's about to report a horrible quarter because there's no one in the parking lots. Like people have all this, they have advanced credit card data. It's possible the more advanced investors have something where they're ahead of the value investors. They know the information that things are bad first. And so you're at a disadvantage as a value investor just using this, historically reported data when everybody's got this new big data that's out there.
More than once I've thought, you see those things with like the AI produced images of people and doing different things. And then they have 6 fingers or a droopy eye or something all messed up. And more than once I've thought, this explains the phenomena of the Walmartian to me. You're familiar with the experience of Walmart.
We're going a different direction here.
Yeah. But what if those were just drones sent by big hedge fund to exploit Walmart pricing data? I'm with you on this one. I mean, big data has changed what's available, but I think what that's really done more than anything is it's changed the tools that are available and the ways that we can reframe, repackage, and tell stories about the data to try to get people on board with, here is the one true way, right way to think about this story that makes you smart. And if we can get enough people to think about this is the one right, true way to think about this data that makes people smart, that's as much as we get a WeWork, as it is a GameStop, as it is we get an Amazon or a Tesla or a take your pick of things that have worked out too, that haven't just been like disastrous frauds and failures. If you have more data points, you have more things to build a story on. And that's a heck of a lot more convenient than being able to go like, hey, we're a great price to book deal. Like, hey, our net position makes us, you could technically buy us and liquidate us tomorrow. Nobody's making that pitch in public markets. This extra data has just given extra resources for telling these stories in different ways. And it's a constant evangelism campaign.
Maybe that'll be with the traditional value investors. Maybe there'll be so many drones over Walmart parking lots that like price to total cars in parking lot will become the standard thing in the future. And people will be doing something more advanced than that to try to get ahead of that. Who knows?
I can't remember if it was Danielle DiMartino Booth or which. Do you remember? One of them owns like a drone company too, and I
Oh, really? I didn't know
remember. eh, Forgive me if it's not her, but it was somebody where, because I remember thinking of that when they were talking about, and obviously big data has become a big thing, and our friend like Matt Ober and Howard and all those guys are doing stuff with this, and they're fascinated by big data sets. And when that became a new thing, and we started to hear the stories about flying the drones over Walmart and everything else, it was like the real trade here is not to get Walmart's quarterly earnings right. The real trade here is who is selling these drones to these hedge funds.
Right.
And how do I get into that business? Because that is a crazy attractive selling story. And if I adjust for those 2 and 20 fees, even if they get the earnings number wrong, but they talk about their drone fleet, I'm just saying, like, there's that second or third order effect or second or third order derivative on all these things. You got to think
that's been, and we're going to talk to this with Aswath about this tomorrow, but that's been the play with AI so far early in the thing is like, forget about what they're doing with AI. Let's just buy NVIDIA, who's allowing them to do it. And that's common in the early stages of these new technologies is like the people that are building the stuff do very well. Now in the future, that may not bode well for NVIDIA's future, but it is interesting. You're right. I mean, you've got to figure out who's like enabling the stuff to happen at the beginning, and that's where you want to be.
Yeah, it's a real question. Who's enabling this stuff? Who's making it happen?
So moving on to the next one, this is another Oswath one I got from listening to him, one of his arguments against value investing, and it's the idea that there's more winner-take-all businesses now. And I think this is interesting. Like the example he gave was Airbnb. So if you're someone who's valuing like hotel companies with the PE ratio, well, if that's becoming more of a winner-take-all industry and Airbnb is perpetually going to be taking share from hotel companies in general, maybe the PE ratio those hotel companies should be trading at is less than the PE ratio those hotel companies should have traded at in the past. So maybe as these businesses become winner-take-all, the bigger companies win, even though they look expensive and the smaller companies look less expensive. Maybe the bigger companies win more and more industries. Now, this is not true of every industry. I don't see like steel being disrupted in this way, but it is interesting to think about that. Like if you have more winner take all businesses, this could be bad in general for value investing.
For all the businesses that can scale, especially off of technology. And I think this is where you get into new factors that rhyme with old factors. So like an Airbnb case is you have the technology layer imposed on top of old brick and mortar hotel real estate, that type of thing. So you get this mix of you have a new factor with a new story around it that maps just enough over an old factor. So people who could understand the old factors go like, okay, I see the merits here. I see what this is. And then once that becomes the dominant narrative, what that does is it makes it really hard to compete against for the old players. And the Airbnb case is really great. Professor Damodaran, when he did the Uber valuation, it was really interesting too, because it's like, what is this taking market share away from? And how is the new story and the new factor that's being used to explain the new story going to build a moat around this thing? Because once you get dominant position, flow takes over again. Like once you're the biggest one in the space and the money is coming in, that takes over. There's still stuff that happens at the margin. That's all the Mike Green stuff on like how this works too. But it's really, really interesting to think about that magic combination of if you can build a factor-esque story over an old factor, you can get enough people around a new dominant narrative and approach a winner-take-all scenario where it's really hard for anybody to outcompete you on the upswing. Airbnb, great example of that. The Uber, Lyft IPOs and all that stuff, great example of that. We've seen a lot of this over the last 10 years.
Because remember, the argument against growth companies has been that as you get bigger and bigger, it becomes harder and harder to sustain high growth rates. And we're seeing a lot of really big tech companies right now that are violating what's happened in the past with respect to that. And that's the question is that going to continue? Are we still in a situation where the bigger these companies get, the more of an advantage they get, it just keeps going and going and going. And that does become a problem for value. I mean, if you're competing against the S&P 500, those types of companies are a huge percentage of the S&P 500 right now. So if they're going to keep winning and winning and winning, and that's not necessarily what I believe, but if you do believe that, it's harder for value in the future, definitely relative to those companies.
It's also interesting too how those companies, so the higher and higher growth rates can't keep going. It's that whole trees don't grow to the sky thing. But what's been really fascinating of the last, call it 10-ish years, is that the companies with the highest growth rates doing the most stuff built the biggest cash positions and or the biggest like venture books. So it's the way that they're finding growth in new categories or from new high risk kind of like barbell type portfolios. We have the old business, but then we have this like venture portfolio that has high growth potential to try to offset that thing. The world's not seen that dynamic before. Like the closest we got to seeing the dynamic to that was like seeing Teledyne do like roll-ups and I don't know, GE get into the mortgage business, like little punctuated upswings, but we've never seen this stacking of tech growth at these levels with basically pools of capital of this size before. Really, really interesting to think about how this all breaks down and why just today is so much different than 20 years ago, let alone 40, 50, 60 years ago.
AI is going to be a really good test for this because typically you would see when you get a new technology like AI, you would see some startups come out of nowhere and become dominant players. But right now, these big companies have such a huge advantage. I mean, they can buy, it costs a lot of money to run these AI models in terms of the hardware you have to buy. They're buying, like the startup companies that are coming, they're buying parts of them. They're owning parts of them. So they're doing everything in their power to keep their control and to not have this company come from nowhere and like dominate the market. And so it'll be interesting to see. I mean, you have to say, being honest about it, like the big tech players have a huge leg up on the startup companies right now just because of what it costs to run these AI models and because of the scale they have. But it'll be interesting to see how it plays out like as we go into the future.
It's going to be very interesting because we're going to find out if, I don't want to invoke Allen Iverson on this, but there's a lot of heartache and letdown. I can tell you as a 76ers fan, like with what comes on the other side of this, you can really get your hopes up for something and then be like, my guy's barely 6 feet tall, maybe 5'11", and sure, he's dominant out there, but just can't bring it all the way home for us, and it'll break some hearts. AI, I hope you don't let us down like the last AI.
So this next one also is basically a similar thing, which is the idea that value is a bet against technology. And one of the things when you talk to at least most long-only value investors, like I know Wes talked about this, Wes Gray, when he was on our podcast, is most of them think you want to have pretty loose sector constraints, at least if you run value long only. If you run it long short, you want to have tight sector constraints. But if you run it long only, you want to have loose sector constraints. And what that's meant over the past decade plus is you've been significantly underweight technology because there just weren't cheap companies in technology. Now you can run it valuation neutral and you can own a bunch of tech companies. But even if you do that, you're still dealing with like the cheapest tech companies. So the cheapest tech companies is not where the innovation has been coming. So you're still underperforming. So this idea is value has been a bet against technology, no matter how you look at it. And is that if technology is going to continue outperforming, if these big companies are going to continue driving the returns of the market, then this bet against technology is a bad thing, and it's going to continue to detract from value's performance going forward. So that's the big question here: is do you think technology is going to continue to lead the market in the indefinite, in the decades ahead, or do you think we're in for some sort of mean reversion here, where maybe these technology companies are not going to be the leaders? It's a question I don't have the answer to, but it's important for value because if you're going to, by your nature, be underweight technology, then whether technology is driving the entire market, the outperformance of the entire market is a very important question to answer.
Back when I'm thinking like magic formula, in my era of like learning my way through Graham, Buffett, Bill Miller, you go through the magic formula, the Greenblatt stage of trying to understand this stuff. And you start to find out about, and I can't remember if it's in which book it's in, but it's definitely from Greenblatt. Like, and then I know Wes Gray talks about it too, about how certain factor things will default ignore certain sectors or certain cohorts where it doesn't apply. Does it ring a bell to you? Like the places you can't use, like EV to EBIT or something like that. Like you can't use like financials, insurance companies because
like every factor has a spot. Like certain ones, financials is the big one you see. Like there's people like Partha Mohanram, I think it was Partha Mohanram, wrote a whole paper about valuing financials because like so many of these ratios don't work well in financials that like a lot of times what people will do is just exclude them from their value screens. But then you run into this problem of like, I don't own any financials. So like if financials are driving the market for a long period of time, I don't have any financials. So you're right. I mean, certain ratios work better in other areas than they do in others.
Which this is where like a composite version can work. Different awareness for different sectors can be really effective on this. But I think anytime, like if you're clinging to value in a definition that it's going to default be exclusionary of a sector like technology, you should at least come up with a way to understand at least that sector inside of your framework so that you're making that call. Is this something I really just want to not own? Or is it something where there's the unintended consequence of when I don't own it, I could systematically underperform for a long time, especially given the size of technology. It makes me think a lot of another good, it's not a perfect analog to this, but I think it's worth mentioning. This is like when I don't know, 5 or 10 years ago when ESG had its big run on gathering assets. And a huge part of that big run on gathering assets was just avoiding all the energy and commodity and other stuff that got absolutely shellacked. So you had no energy in the portfolio, you had an overweight to tech, and you had basically an underweight to like most financials just because of the size to make that up. Made those ESG funds look really, really good 5-10 years out of the gate coming off the financial crisis on raising those assets. They were doing it masquerading under the name of, oh, it's the quality, it's all these things. And it's like, well, actually, if I just net out some of the sector exposure, that seems to generate most of your returns when I look back. You have to be really careful on when you're netting this stuff out, what you're going to compare back to, and if that logically matches what the logic is that you're hoping to use. If it's the logic you can stick to, you get a pass so long as you can stick to your logic and it's consistent. If you're just performance chasing and you're not asking these questions, you can probably expect to be disappointed.
So on a side note with the ESG thing, like I'm not one to judge whether people should be investing based on ESG or not. I mean, I'm not a believer that it actually works performance wise, but it is interesting, like how many people were not true believers in ESG of the people investing in ESG, because as soon as the energy stocks and everything turned up and like the thing wasn't leading to outperformance, like the run for the exits on ESG. I mean, how much do you hear about ESG anymore? Like not that much. Like a lot of it was the fact that I could do good and I could outperform at the same time. And as soon as you took away the outperform at the same time part, like a lot of less people are interested in ESG than were before.
The beautiful thing about this run in energy and sort of like the ESG coming, the shine coming off as a marketing screen and all the other things is like that shine came off. And now we're back to the ESG shops that we talk to, some of the clients we have that allocate in this way. We're back to at least people following through on values and the performance chases out of there. I'm all about a cottage or a niche industry existing around values that people stick to, even if they're not totally mathematically or scientifically sound in some way. If that's the thing you're allocating money to, fantastic. It's when you're chasing performance and you're like, oh, I'm going to do good too. I'm going to save the world. It's like, just, oh man. Yeah. Let's be a little bit more skeptical here, people.
And it's great now because like the people who are doing ESG now are the people who actually believe in ESG, which is the way you want it in the first place. Like
this is what I love.
Weak hands who didn't want to be doing ESG in the first place, who thought they somehow were outperforming because of it. And now now ESG will become what it should be, which is, I think it's great if people want to invest that way and they want to invest to make a better world that way. I think that's fantastic. But just understand what you're getting into, which is you're probably not going to outperform the market by 300 basis points a year while you're doing it.
Yeah. Know what you're betting for, know what you're betting against, make sure you're in alignment with that thing. And if what you're betting for is positive performance and you're going, I like this manager because of the positive performance, but it really works out, it regresses down to, they didn't own any energy stocks and they were overweight tech. That's the kind of information you want to be on board with if your value alignment is really with the net performance figure.
And just one more point on this values bet against technology. Like one of the other arguments you can make is there are ways to correct this in terms of you can start adjusting for intangible assets. Like we know, like if I'm running a price to book screen against the technology sector, it's pretty much garbage. Like there's just no point in running a price to book screen against the technology sector because most of the assets they have aren't reflected in that. So, there's the basic way if I can adjust the financial statements, I can capitalize R&D, I can try to do it better. But there's people like Kai Wu, we had in the podcast, who think there's even better ways to do it with advanced data. And he's come up with a bunch of different ratios that are price relative to something that actually does try to measure that intangible value. So there are ways to limit this. If you're a believer in that type of stuff, there are ways to limit this bet against technology by trying to say, can I come up with metrics that more appropriately value technology companies so I can use value, but I can use it in a different way from the standard ones you'll see, on the financial statements.
You got to have, again, I think that highlights the aligning your values point with the thing that's going to be your expression of what this is. If I want to have intangibles because I want to be able to consider technology, these are those critical ways that I can actually take the strategy I have and fit it so that I'm not in just some pure exclusionary place, so that I actually have a thoughtful approach to how I think about this. Kai Wu's doing some brilliant work. It's really interesting if you want to figure out how to do this.
So the last one I have, this comes from Aaron Stanhope, and it seems like every time we've got these great, insightful things in the podcast, they're coming from Aaron Stanhope. But this is a blog post he wrote a really, really long time ago, but I keep reposting. I'll put the chart in the podcast. But he looked at all the different factors and in the pre-recession period or during a recession, post-recession, then during just a standard expansion, which factors outperform. And what he found is values outperformance comes largely in and around recessions. Like in the pure expansionary period, that was not the time to hold value. Pre-recession, recession, and post-recession, that's where a lot of the outperformance of value came. So if you argue, and we have seen this, I mean, we're seeing less recessions than we've seen in the past. We also, you could argue, and 2020 is a great example of this, although that was an exogenous thing, like these recessions are quicker now. The up and down is quicker. So you can argue if a lot of values outperformance historically comes around these recessionary periods, if we have less and quicker recessionary periods, maybe value is not going to work as well as it has in the past. So again, I don't have an answer on this, but I think it's an interesting argument to think about. If something has changed economically where the periods where value works are shorter, maybe value is not going to work as well as it has in the past.
To quote the poet Rob Thomas, man, it's a hot one. These things work in seasons. They work in phases. You can smooth this stuff out and you can see it get rough again. And I'm pretty confident that that's what we're seeing. Like, is the economic cycle smoothing? Back to the first one, like, did the Fed change the game? We could do all these things, but it's just stuff coming in and out of style. It's just styles coming in and out of like our cultural awareness and the stories around them. It's Santana being a hit, in the 70s and then coming back and being a hit again in the 90s when he partners with Rob Thomas for that song that's now going to be stuck in my head that I don't know. Suffice it to say, we've now covered Charlton Heston. We've gone from the 10 Commandments to Wu-Tang references to bringing it on home to Santana takes that are 25 years stale. But it's this idea of like things come in and out of style. They come in and out of vogue. And there are always going to be periods where it feels like stuff like the variance has been squashed or things have been there. So is the economic cycle smoothing, but now we just have crazier moments of terror like pandemics? Like, I don't know, but we all have to adapt the strategies and the way we understand them to fit the situation that we're dealing with. If finance has taught us anything, I feel this. I don't know if you feel this way too. It's like my default skepticism for anything that's going smoothly, I've just learned to like embrace in most of life. The only things we can rely on to have stick-to-itness and like get through are the things that like survive when the smooth road turns into a horribly rocky or bumpy road. And then you look around and you're like, who's still with me on this? The more that people argue like the economic cycle is smoothed or whatever else, I look at things like the pandemic and I go, oh no, this is not a good sign if we think things are smoothing out when the variance on these horrific events seems like it just gets worse and worse.
Yeah, that's right. And what's interesting is if you look at the bottom right here, this is most people will see the big chart here, but the bottom right is interesting. So like this was the percentage of time we were in each one of these historically. So we were in a pure expansion 61% of the time historically. And then the pre, post, and during recession was 39% of the time. So I would argue, this chart goes through 2015. I would argue in the post 2015, that pre, during, and post recession is probably not been 39% of the time. It's been less than that. And so that gets to the argument is if that is less, is that necessarily a bad thing for value? Which I don't think it is, but I think it's an interesting point to make because I think this is a really interesting chart to think about like when the factors have worked historically and when they've not worked historically.
And how much time they need to work. Because the other thing is if you have like how many cheap price to book situations went off the table when we shut the world down for COVID? Like, would there have been more cigar butts if we had like play out a different version of history? If we had gone through this in the way that we might have gone through this in the 60s or like the Spanish flu version, were there more cigar butts in the Spanish flu? Like, I don't know. Like this stuff is really, it's wonky, but you have to take this in when we understand this in the context of history. This stuff isn't static.
And what's interesting, and this is one of the reasons I think O'Shaughnessy ended up getting rid of price to book, is price to book was a proxy for bankruptcy risk in the Great Depression. So basically, the low price to book stocks were the ones that were all going bankrupt. So like when they expanded their data set to see more than they had seen, that's when they went to like an enhanced price to book, or just excluded it from some of their composites by saying like, all right, we've brought in this new information and we've realized, maybe this price to book, maybe it's not just what's going on now, but looking at a full history, maybe this price to book isn't what we thought it was.
Where's my Altman Z score? Come save me.
I have nightmares about that thing. I'm trying to program that thing from back in the day. But anyway, moving to the conclusion, I think it's just, I think this is really interesting. And so I'm trying to think about, like, we've taken both sides of a lot of stuff. So people are probably asking, like, what are the takeaways from this? And I think there's a few takeaways. I think one is what I just said, which is this is hard. There's smart people on either side. I don't know whether value, I mean, obviously I'm a believer in value, at least as part of what you do in a portfolio. I'm a believer it's going to work over time, but I understand there's really smart people on the other side of that argument. I also understand that probably value needs to be enhanced. You're probably, I mean, I don't know too many people, and I talk to a lot of quant investors that are sitting here running, pure price to book screens anymore. Most people have gotten rid of it altogether. If they're using it, it's part of a composite. So people are learning, they're evolving, they're doing things in different ways. So pure price to book value, is that dead is a different question than is an intelligently put together value strategy that incorporates what we know now, is that dead? So I think it's important to maybe keep those two things in mind. And also, like, the Michael Mauboussin, you got to go back to him and Aswath again. Like, the way they define value investing is never going to be dead, because value investing is buying something for less than it's worth. And you'll always be able to do that, no matter whether you're doing it with a price to book or you're doing it with something that has nothing to do with any quantitative method, you'll always be able to do that. So I'm not sure there's a takeaway here. I mean, I think there's still pretty good arguments for, like, using statistical value investing done in the right way. But I also understand there's strong arguments on the other side too.
Both arguments in both directions to help nuance the point around who you are and why you believe something works, with some evidence that it actually works over time. And I look at this and I say, from both directions, both buyers and sellers of all strategies, of ideologies, have to meet in this marketplace to make these decisions. So to still be able to look at something, and even if the definition of value is still as simple as, do I think this thing will be worth more tomorrow or in a year or in 5 years than it is today, break down those layers of why. And the things that I think have evolved the most that everybody can look at are, if you think fundamentally, add the nuance of, add some trend or technical or other categorization to it, add sentiment, add flow, add several more layers of why to say, like, okay, for me to be right on this multi-dimensional look, what are the various other categories that I need to be right for this to play out over my time horizon? The act of asking those questions is actually as old as time. That's been around for the whole thing. And we can take it all the way back to the price to book days and saying, like, hey, if this thing just doesn't go bankrupt, I could buy the whole thing out and take it private. And then maybe my little Berkshire Hathaway company will flourish over time, or whatever the stories are going to be. But this idea of, you have to have a constantly evolving, like, composite view of how you see the world and the things that you're going to invest in, and then all the different layers of reasoning on why you think it's going to be right. And it can't just be your little narrow lens of one thing only for why you think you're going to be right. Because if you do that, you're overlooking all the other people and all the other ways they think about it. And you might miss the point of, are enough of them going to get on the same page as you over time so that you can get out of the thing you just got into?
Yeah, I think there's two questions you want to ask yourself. One is, when you think about something like, is something dead in the market? One is, do I have to even make that decision? And then the second is, if I'm making that decision, like, what other things can I do along with it where I'm not just betting on that one answer? And so I could be an index investor and I don't have to make the decision about, is value investing dead? So that's an option for people. I also, if I'm building a value portfolio, I can bet on momentum, or a factor portfolio. I can bet on momentum. I can bet on quality. I can bet on a bunch of other stuff. So that decision about if value investing is dead, it's not my full portfolio riding on that. It's a portion of what I'm doing. And I can do value in a more thoughtful way than the price to book, which increases my odds that maybe the answer is it's not dead. So I think it's tempting to look at this in terms of, like, I have to figure out whether value investing is dead, but I think most people don't have to make that decision. And the other thing I would make, and this is kind of the argument the opposite way, is, like, if you're a S&P 500 investor right now, you are making a big bet on size, because the index is exceptionally concentrated. So I would argue at the current time, like, that's a decision you have to make. Like, adding a little bit of value to your portfolio might be a good thing, because maybe you're mitigating the risk that these big companies are not going to be what we think they're going to be, and they're not going to dominate the world forever. So coupling that strategy with the value strategy, you could argue it's actually a good thing right now. I don't know. I don't know if you think that, but it's something I think about.
I think about it a lot. And I think about it a lot from the standpoint of, what you just said. If you're a passive investor, you have to ask you should ask a version of these same questions. It's just important that we think about, goes back to that idea we talked about. I think it was on the podcast from last week when we were talking about the best of from the last question. And the point gets raised about, just thinking about like what you actually value and like what's sacred and dear to you over time, you want to make sure, like, no matter what, unless you're just going to be passive and mail the whole thing in, like if these are savings, if you're going to protect these things, or if you need these to grow and how you're going to parse that out in your mind, if you're making investments in the future, you should at least have some attentional awareness to why you think this thing makes sense and what the risks are that you're bearing by doing that. If you're full on market cap weighted, like passive funds, hopefully you understand what those drawdowns look like every now and then when things get tilted out of whack. And I'm in your camp on this one. There's certain things where it's just like, just diversify a little. If nothing else, diversify a little. Let's not just bet on this one thing.
Yeah. And it's not like you have to, it's not like you look at that and you're like, well, you should be out of the market cap weighted indexes and you should be 100% value. Like that's sort of the opposite of what we're talking about. But it is interesting to think, like, as the index becomes more and more concentrated, and I don't know whether it will or not, if these companies continue to dominate, that'll be a great bet to bet on the indexes. But like, for me, I'm always like a split the difference type of guy, and everything I do from the ground in terms of the value factors we use multiple factors. Like I try to do multiple things. So like, to me, and I'm not a person who owns index funds anyway, but if I was, I would think about like, what does the version of the world look like where these companies don't dominate? Like if what's happened in the past, where when you look in one decade and look at the top 10 companies in the S&P, and then you look at the next decade, most of them aren't there anymore. If that's what happens, and I'm not saying it is because I don't know, like maybe I want to have at least some bet on something that's more fundamentally based as part of my portfolio. So I'm always a believer in that in all different directions, is in terms of like trying to split the difference and trying to understand that I don't know what the world's going to bring in the future. So trying to have, something that does well in various outcomes.
My takeaway is value investing may or may not be dead, but one thing's for sure, at least as of this very second when I'm making this statement, I am not dead, and I should probably think about this.
That's true. Until we bring you back with AI and the podcast continues beyond you. But
Corey B.
I would think if I was thinking of all the people I know, like that I could program an AI to be, I think you would probably be like dead last on that list. I'm just not sure that the combination of Moses and the Wu-Tang Clan can be done via AI. I think it's probably impossible.
All you got to do is just, spill a little bit of that drink into the computer.
Right.
Let it
go.
spark a little bit.
Right.
That's how you achieve this level of ADHD.
Well, on that note, that's a good note to wrap up on. We'll see everybody next time.
Hi guys, this is Justin again. Thanks so much for tuning into this episode. You can follow Jack on Twitter at @PracticalQuant. You can follow me on Twitter at JJCarbonneau, and follow Matt on Twitter at @CultishCreative. If you found this discussion interesting and valuable, please subscribe in either iTunes or on YouTube, or leave a review or a comment. Also, if you have any ideas for topics you'd like us to cover in the future, please email us at excessreturnspod@gmail.com. We would like this to be a listener-driven podcast and would appreciate any suggestions. Thank you.